on the earlier stream today, it seemed like people had questions on like how to read the income statement. Somebody was asking about why is free cash flow negative, net income positive. So I thought I'd go through Meta's 10K. We'll go through the income statement line by line because I think people are intimidated by financial statements. But I think once you see how kind of straightforward they are, it's actually not too hard. So if you want to be a co-host, you could join me on the stream. The link's in the description here. That's the link right there. So I'll go to the income statement. We go through it line by line because it's not too difficult reading through financials. You just got to keep doing it, and then it starts to make more and more sense each time. And they all follow the same pattern. Every income statement has revenue on top, and then expenses, and then net income on the bottom. So revenue is usually represented in thousands or millions. This is in millions. So it's a pretty straightforward income statement, pretty easy to read, right? There's not much going on. You can see their revenue actually was flat. It went down from 21 to 22. Then it jumped up a lot in 23. Their stock has been going up a lot in the past year. So I always search the revenue number because I think you should probably search most numbers to understand it better. Because if you want to understand what these things mean, you just have to. You can Google the term, or you can just see what they say about it. But I always try to look at revenue to get to understand what the revenue is, because you might think you know what the revenue is for a company, but sometimes you'd be surprised that you thought what they're like. For instance, Coca-Cola, people think, oh, they get revenue from selling cans of Coke. But actually, a lot of their revenue isn't selling soda. They sell syrup. And then they don't even usually make the soda. Other companies make the soda. They just sell the syrup, and other companies manufacture. They do have an arm that manufactures and makes the cans, but most of their business is selling syrup, not soda, or not making soda either. That's why they're such a profitable company. So always the first thing I like to do, if you just joined, we're talking about the income statement. Let me go back to it. Okay. So it's page 91 is the income statement. Let me write that down. So page 91. I'll write in the chat so I don't forget. Actually, page 90. Page 90 of 147. Well, page 91, actually. Page 91 of 147. So don't forget. Let me delete that comment. Okay, so every income statement starts with revenue on top, or sales. Those are interchangeable, revenue, sales. And I recommend to, if you want to really understand this stuff, I recommend to Google search each number so you know what it is. You can also search the term here, like cost of revenue. Or you can Google it, of course. So just search that 135 billion, so you know what it is. And you might already know this, but most of their revenue is advertising, like 99% of their revenue is advertising. So 132 billion of their revenue is just selling advertising space on their different platforms. 1 billion is other revenue. 1.9 billion is Reality Labs. The Oculus. And here's a breakdown of the revenue by location. 52 billion in the US and Canada, 31 billion Europe, 36 billion APAC, 15 billion rest of the world. But you should look, like, what is other revenue? $1 billion, even though it's a small percentage, what is it? Let's see if we could figure that out. Other revenue. Okay, let's see. Other revenue, which consists of revenue from WhatsApp business platform. I don't know if that really explains it too much. Okay, here, other revenue. Here, again, it says WhatsApp business platform. Net fees we receive from developers using our payments infrastructure and revenue from various sources. So I guess it's from WhatsApp, and I guess they get revenue from the developers who charge fees for using their platform. I'm not totally sure what other revenue is. Okay, so there are other. So Reality Labs is how they also get revenue. Reality Labs revenue is generated from the delivery of consumer hardware products, such as MetaQuest, wearables, that's Oculus, and related software and content. But 99% of their revenue is their family of apps, FOA. So we generate all our revenue from advertising. Our advertising revenue is generated by displaying ad products on Facebook, Instagram, Messenger, and third-party applications. Marketers pay for ad products either directly or through their relationships with advertising agencies or resellers, based on the number of impressions delivered or the number of actions, such as clicks. So they charge people to put ad space like on Facebook, and they'll charge per click. So every time somebody gets a click to their website, then maybe Meta charges them $1 per click or something like that. And it's worth it because a lot of people make their business by advertising on Google and Facebook. FOA is family of apps, which is mainly Instagram, WhatsApp, and Facebook. Let's go back to page 91. Then you have all the operating expenses. So in order to generate this 135 billion of revenue, they have to pay 26 billion for cost of revenue. Cost of revenue is different than operating expenses. It is kind of lumped in with them, but cost of revenue are the revenue directly tied to generating revenue, because certain expenses are not directly tied to generating revenue. Like for a manufacturing company, the payroll for the person actually making the product in the warehouse making the product is part of cost of revenue. But the payroll for the people not making the product, like the CEO, that's part of operating expenses. So 26 billion of cost of revenue. Let's see what that is. Cost of revenue are expenses with the delivery and distribution of our products mainly include expenses related to the operation of our data centers and technical infrastructure, such as depreciation expense from servers, network infrastructure, and buildings. So it's depreciation of these fixed assets. Servers are a fixed asset, so is the buildings and the like the data centers and physical buildings where people work, as well as payroll-related expenses, which include stock-based compensation for employees on our operations team. So stock-based compensation is a part of their operating expenses. And of course, bandwidth costs. Any technology company is going to spend a lot on bandwidth because it's expensive to maintain these websites. Could you imagine how much money it costs to maintain Facebook? So all those millions of users can use it without getting freezing or getting knocked off. Like if you have your own website, you have to pay, to host someone to host a website, but you also have to pay for memory so people can use it and it doesn't freeze up on them. Because if you have like 1 or 2 videos on your website and a bunch of words, it probably won't freeze. But could you imagine having like hundreds of videos? You're going to need a lot of bandwidth. And so if you're ever not sure exactly like what something is in the income statement, just Google it, like bandwidth. You probably kind of know what it is, but the way you really know something is if you could explain it to somebody where they understand it. If you can't explain something to somebody, well, think about it. If you can't explain something to a 7-year-old where they understand it, you don't really understand it that well. So what are bandwidth costs? Like I know it costs YouTube a lot of money to serve up high definition video content to millions of people every day, but why? Basically, it's a fee you pay per gigabyte transferred through the companies that provide you the internet connection to the data center. These companies create the networks that is part of the internet. So for instance, the transoceanic cables between the Americas and Europe is privately owned. So one video is say 100 megabytes and you pay $1 per gigabyte, then the bandwidth. This is hard to really follow. Let's see someone else. If you connect to the internet, you pay for it. Mobile phone, cable internet, whatever. It costs money to purchase and operate the equipment involved. If you want to move more data faster, higher grade equipment, more complex engineering, and more electricity required. So cost increase. You want a certain level. That's also kind of. Let's see if we find what bandwidth costs for dummies. What is the meaning of bandwidth cost? Bandwidth costs describe the utility cost for telecommunication services based on capacity, usage, and reliability tier. So that's pretty straightforward. YouTube is the highest reliability tier, requires high-speed service, and must handle many concurrent streams, a high bandwidth and cost. Because they must spend a ton of money on bandwidth costs because they need to have the ability where millions of people can watch a video at the same time without freezing, without disruption. Of course, part of it is your cable internet speed too. They can only do so much. As long as you have a good internet service provider, you'll be able to watch it. But they're doing their job, or at least that's the idea. So cost of revenue also includes costs associated with partner agreements, including traffic acquisition costs and credit card and other fees related to processing customer transactions. So when they sell ad space, the transaction costs, like the credit card company charges them a fee. That's part of their cost of revenue. RL, Reality Labs inventory costs, which consist of cost of products sold and estimated losses. So the cost to buy the physical equipment is part of cost of revenue, which you probably knew that already. So below cost of revenue is R&D. That's their biggest expense, $38 billion. So lots of R&D. You should, if you want to learn this stuff, I thought you should search the word in the statement, in this statement. Well, search a dollar amount too, but you should also Google it, because sometimes when you read about like what is R&D for Meta, you might get an idea of it, but sometimes it's easy to Google it or read Investopedia. Like a high level definition may be a little easier to absorb. And also you want to look at these expenses as a percent of revenue. So it's right here. So R&D is 29% of revenue. So of course, R&D is going to probably go up as revenue goes up, but is it going up as a percent of revenue more? From 2021 to 2022, R&D did increase a lot more as a percent of revenue. It went from 21% to 30%, but it came down in 2023 to 29%. So it's hard to look at numbers on a nominal basis. So as a percent of revenue makes a little more sense. Cost of revenue. This is a good page. Cost of revenue. Agav. Yeah, it's live. Not many people, but it's live. So cost of revenue was 19% of revenue in 2021, up to 22% in 2022, back down to 19% in 2023. That's what you want to see. You want to see economies of scale. Let me know if there's a economies of scale. I don't know if you've taken an economics class, but that means as you increase revenue, your expenses are increasing at a lower rate because you're able to build more efficiencies in. Because if you have a factory and you make products in the factory, say you make 100 products in your factory. And it's $5 profit per product. So total profit is $500. Probably cost of bad weather. So say you have a factory and say it's just you're by yourself. It's a small factory and you rent it out. You rent it out for, say, $1,500 a month. So economies of scale is the factory is kind of a fixed cost, right? you don't have to pay more per month because you're making more products. So maybe in month one, you make 100 products and you have a profit of $500. So, but you paid $1,500 for the factory, so you're actually losing money. In month two, you get a little better at making the products. You get a little faster. You figure out like techniques. So you make 200 products, $500 profit. So now you lost $500 a month too. And then in month three, you make 300 products. So that's economies of scale. You're making more products, but you're kind of saving on money. But what even better is when you make more products, say in month four, you make 500 products, but your profit is $6 because you got a discount from your supplier because now you're buying in bulk. The first few months you weren't buying enough, but your supplier says, yes, if you buy 500 products from us, we'll give you it for $1 less. We'll sell it to you for $1 less. So that's kind of economies of scale. The more you sell of a product, the more money you make because you're able to you're breaking through your fixed costs and you becoming more profitable, and you're able to get things at a cheaper price. You may not need as many people to scale. But it can be confusing because you would think cost of revenue, because their revenue goes, actually, it was flat, their revenue from 21 to 22. Yet their cost of revenue went up. So that's why their percent also went up. But you can see that cost of revenue was the same, almost the same from 22 to 23. But their revenue went up a lot from 22 to 23. Maybe it's easier if I show you. Actually, let me take a picture of the income statement. Yeah, Gob, I haven't seen you in a while on these streams. And if you guys have your own business or are looking to buy a small business, this is what you do as well. To understand things. This is what I did with my small business. I could show you. I was just talking to somebody about opening another Mathnasium franchise. And I kept track of every single month. I kept track of my revenue, my payroll, my marketing, my margins, and I was able to show them for 9.5 years. This is actually a good way. This is a good thing to do if you want to get better at due diligence and analyzing companies. This also is going to help you kind of like understand these financial statements better. And I would do this. I would actually write it down, whether it's on a computer or a piece of paper. It's going to help it'll kind of click quicker if you, because when you just read financial statements or when you just read about a book about accounting, it's kind of in one ear out the other. If you actually participate, if you actually had a business and you were doing their financial statements, you would really understand it well. I mean, of course, you might make mistakes in the beginning. So this is why you could just recreate it. Because especially if you talk to somebody about Meta and you try to like explain why you think Meta is a good investment or bad investment, if you actually recreated their, I'm not good with keeping track of my numbers. It's hard. It takes a lot of time, and some people don't even know where to start. Yeah, if you recreate their income statement, and I'm not even doing anything like hard, I'm just retyping the numbers. I guarantee you'll be able to like talk about it in a really intelligent way. Like they'll be like, wow, you know a lot about Meta. Like all I have to do is and if you just let's see. And this is just recreating what's already in the 10K, but it'll really help you understand it better. I mean, you could copy and paste, but I would just type it like this. And then every quarter you can just retype it and add it to your Excel file and redo the calculations. Oh my God. Okay. So you see all these expenses. I mean, it looks high. Well, big expenses, but it's hard to tell. I would do something like this. I mean, you could look at it a lot of different ways, but I would look at all the expenses as a percent of revenue. You don't have to be great at Excel. You'll get better at Excel. Okay. So actually their revenue, maybe I'll make this red because it went down from 21 to 22. So you would expect expenses to move with revenue, but the ideal situation is that expenses go up less as a percent of revenue. So from 21 to 22, that wasn't good. That's why I think the stock came down a lot. Remember, Meta fell to like 90 or 88. Wishing I wasn't buying a house. Meta stock dropped a couple years ago. I know. So it came down a lot, and it looks bad from 21 to 22. Every quarter they weren't hitting their targets, and the stock kept dropping. I remember, but I was like, this company, has so much revenue, 116 billion. But when you look at the income statement, it does make sense. Like their revenue was pretty much flat, like down. Let's see how much it decreased. It decreased 1.1% from 21 to 22. So it decreased 1%. But the cost of revenue increased 11.5%. R&D increased 43%. That's a big increase. I mean, considering revenue decreased, you would hope expenses would remain flat. I mean, hopefully they would actually go down, their expenses. Instead, they went up a lot. That's what you call inflation. I sold Meta at the lows. A lot of people did. That's what happens when stocks go down. People get scared. People generally buy stocks the wrong time and sell at the wrong time. It's just hard to. So it looks bad, right? The cost of revenue. These are the expenses as a percent of revenue. So it went from 19 to 22. You want it to go down. Then it went back down to 19, which is good. R&D went from 21% to 30%. It came down, but it's still pretty high. The only thing that's G&A is the only thing that's improved a lot. It went from 12%. It went up a little bit, but then it came back down to 9%. So you want these percentages to go down because you want them to grow their revenue and not grow their expenses that much. Just grow them a little bit. But when you look at the overall expenses, it was really bad from 21 to 22. 60% of their revenue was expenses in 2021. 75%. That's a big jump. Their expenses grew. Let's see the dollar amount. $16.5 billion. They went up $16.5 billion, while revenue was down 1.1%, which is terrible, really terrible. But they rebounded really well. Zuckerberg did a great job. He laid off a lot of people, and that's what you have to do sometimes. When there's a division or when there's multiple divisions that are not profitable, that are just draining cash, just cut it out. You got to get back to profitability. Cooler, what's up? The metaverse never took off. But I'm telling you, they put so much money into the metaverse. They have the infrastructure, and AI is getting big. Don't think it's a waste of money. Sure, they didn't generate much revenue, but they're waiting. Like AI is catching up to them. They're already ahead of the game, and I think that's why the stock went up 400% from 90 to 500. And I think there's a lot more room to go. I think they're poised to be the first $10 trillion company. But I have a lot invested in them. Of course, I hope that. So they really improved a lot. They went from 75% expenses was 75% of revenue, and they brought it back down to 65%. No wonder the stock shot way up to 500. So that's a big improvement. So this is kind of like how you kind of do really deep due diligence. This is after the fact, right? Now you see their numbers. The stock already shot way up. So you have to try to look on a quarterly basis and track it on a quarterly basis. And maybe you would see these trends and start investing. But if you want to know more about, yeah, they have a lot. They have so much advertising revenue. They could handle. It's kind of like if you're if you're investing, right, and you have like, and if you were lucky enough to invest in Nvidia, you could have turned like 10K to 150K. So you were set. Your portfolio looks great if you pick that. So you could handle, like, even if you had a few duds in there, say, you know, I don't know, you could pick any stock. I'm just gonna say just, you know, stock X, stock Y, and you put 10K, and this is 5K. And this is 2K. It's kind of like the same thing with Meta. Like, you can handle making bad decisions as long as you have something that's pulling you up. Like, if you had Nvidia in your portfolio, you can make a stupid investment, you know, not a stupid, but risky investment, and it just didn't pan out. So they have so much coming in on their advertising, like, it's just unbelievable amount of cash flow. They could take some risks. They could try it out. And I don't think it was a bad risk. Like I said, they have an amazing infrastructure waiting to be used once the AI catches up to them. So it's not a lost cause. At least I hope so. But this is kind of like what you would do. And a lot of people say, oh, I don't really understand how to look at financials. I don't understand what these things mean. So you just search a term. You search it, like general and administrative. I could see why some people might question, like, what exactly is that? So you just look up the dollar amount and let's see what they say. Okay, here's the percentage, which we kind of looked at. 8, 10, 8, which we already did the math on, which was good. So G&A, that actually went down from 2022. It decreased 400 million compared to 2022. The decrease is mainly due to lower payroll. We knew they got rid of a lot of people. They trimmed the fat, so to speak, as a result of a decrease in employee headcount. So we kind of knew that already. But I would, if you really want to understand this stuff, I would just I would Google it. And it still might not register the first time you do it. Maybe the next time you look at a company's financial statement, you look at what their G&A is, and then you Google it again. And after you read a few of them, then you start getting used to it. So that's why people ask me, like, how come, like somebody asked me earlier, how come a company has negative free cash flow but a positive net income? So I already knew it's probably stock-based compensation because I've seen it so many times, and it was. But even if it wasn't, you just keep learning little by little. You sold NVIDIA 300. I didn't invest in NVIDIA, and I feel stupid. I totally didn't see that one. I totally missed that. But this is how you learn, I guess. I did not realize, like, I know what semiconductors are. Like, I know you need semiconductor chips for computers. I didn't realize semiconductors were so prevalent in other things. Like, now I understand it a little better. But I totally didn't realize NVIDIA's semiconductors are so much more advanced than other companies' semiconductor chips. Like, I would never known that. Because in the late 90s and early 2000s, Intel was like the king. They were the king of semiconductor chips. Like, when I was growing up, computers weren't even that popular. Most people didn't have them in their home. I got my first computer when I was a junior in high school. But they were the reason that PCs became mainstream. People had computers in their homes. Like, it was unheard of to have a computer in a lot of people's homes. Even some companies didn't have computers. They were only for and they didn't even work that well in the early 90s. Like, it was hard to even use computers. But then companies started getting computers. They were in people's homes. People started using them to write papers for school. They started using them for email and games, of course, browsing the internet. And it was Intel. They were the reason computers, because their semiconductor chips were used in most of these computers. But now, like, their semiconductor chips are considered like ancient. NVIDIA has like the best. But even if you didn't invest in these stocks, you try to understand it. Like, I'm trying to understand it. So maybe the next time something happens. Buffett didn't invest in NVIDIA. I mean, people say he's out of touch, but I try to invest in things that make sense. I mean, NVIDIA makes sense. I want to say it doesn't make sense. I just didn't connect it to them being so much better than everybody else. Okay, so let's go back to this. So there's interest and other income. That's kind of all over the place. Income from operations. Operating income. Let's write that down. It's better to recreate it. You'll remember it a lot better, and you'll absorb it. Actually, we could just do the math. It's already here. Operating income. Operating margin. So it's operating income over revenue is operating margin. Scott, did you see Intel as a foundry play for Made in America last year? Yeah, no, I do. That's why I invested in Intel. Because you guys so semiconductor. So there's this Foundry, in case anybody didn't know, if anybody wants to join a live stream, click the link. You can join. We could talk. You can be a co-host. Anybody can. The metaverse never took off. So Foundry and Fabless. Come on. Okay, so semiconductor companies are usually considered foundry or fabless. Fab is this is how you, like, if you Google these terms or read about it enough, it starts to click. So, but fab is short for fabrication. So it's like manufacturing, fabrication, to make something. So fabrication less, meaning no manufacturing. So the biggest fabless company is, not even close to anybody else, NVIDIA. And Foundry are the companies that manufacture the semiconductor chips. So the biggest foundry is Taiwan Semiconductor. So they've been the biggest foundry for a long time. And they used to be the biggest semiconductor company from like 20, I don't know, 16 to 2022 or 2021. Taiwan was the biggest semiconductor company for many, many years. And, 25 years ago, Intel was massive, was bigger than everybody else combined for a couple of decades. But Taiwan, for many, many years, Taiwan was the largest semiconductor company. NVIDIA is now, just unbelievable. But so Intel does both. There's a foundry and a fabless. So NVIDIA just designs the semiconductor chips and wafers. And then they have Taiwan Semiconductor manufacture those chips. So NVIDIA just focuses on designing. And they have the best chips by far, highest quality. Their chips are used in AI, data centers, etc. And Intel, they were, for many, many years, they were the reason for the PC boom. So they designed really good semiconductor chips 25 years ago. But they've been really trying to get into the foundry space. And Stinkbid was saying, I thought like they put a lot of money into, they were doing acquisitions. So I thought they were gonna start moving up again, would probably be a good diversification. AI seems like it's going to lift the rest of these guys. AI is a bubble. It's got to pop sometime. Like, it's just getting a little too out of control. And I'm not saying it is the future. But it's kind of like EV cars. Like it went crazy. EV, oh my God, it's the new, everything's going to be EV. We're not going to have any cars anymore. We're not going to have oil anymore. We're not going to have, that was for several years. Remember Tesla, NIO? Now nobody cares about EV anymore. So it'll flatten out. But yeah, I thought they were doing a good job of acquisitions. There's some pretty big acquisitions. And they purchased McAfee, but that was a while ago. But they did some Tower, that was a big one, right? They acquired Tower, that was an Israeli company, for $5.4 billion. Yeah, they terminated the acquisition as a fail to obtain. Okay, yeah, that didn't get approval from Chinese regulators. I remember that. They acquired Finnish graphics Siru Innovations. I don't think that was that big, but they never really. I don't know if it's going to take off. I ended up selling my Intel. I kind of got fed up with it. So you can see they really Meta really improved the operating margin, operating income, and operating margin are really important numbers to look at on the income statement. More important than net income, because net income can be pretty influenced by like interest income and like impairments of other things. So they did a great job. His margins, Zuckerberg brought them from 25% to 35% operating margin. It's a great improvement. Still lower than 2021, but it's the same operating income as 2021. So, but he's proved he can, turn the ship around, so to speak. Wondering why Michael Burry would. He bought Big Lots. That's not a bad investment. I'm 91. Okay, so interest income. A lot of companies are posting record interest income because interest rates are really high due to inflation. Like you can get money market accounts are paying like 4 or 5% interest. If 3 years ago, for like a decade, between like 2010 and 2021, interest rates were like less than 1%. Now in money market, you can start getting pretty good returns. So interest income, 677 million. So 1.6 billion is from interest income. Interest expense, that's the interest they pay in their debt, 446 million. Then you have foreign currency exchange losses because they do business in other countries. So they may receive payments in yen or maybe in Canadian dollar, and they convert it to US dollars. But you can see how much their interest income, it was 460 million and 480 million, but now it's 1.6 billion because rates are just so high. They don't really, you can see it grew 256%. Here, interest income increased 800 million compared to 2022. The increase in interest income was due to a combination of higher interest rates and higher balances compared to the same period. Because they have a lot of cash. So when interest rates go up, banks hold a lot of cash. Insurance companies hold a lot of cash. Credit card processing companies like PayPal, eBay, MasterCard, they hold a lot of cash because people pay for things, and then the credit card company or the bank, they hold the cash for maybe a day or two and then send it to the recipient. So they're sitting on, at any point in time, sometimes hundreds of billions of dollars of cash. So they earn interest on that overnight. So even if it's like a 1% interest rate overnight, that can be a lot of money. So that's, but those are temporary things. Interest rates will start coming down again. But EPS, like if you just look at, like you see their net income is almost identical from 21 to 23. But you should look at earnings per share. Look how much higher EPS is. It was $14 in 2021, $15 in 2023. And it could only be one answer for that, is their shares have gone down a lot. Look how much their shares have gone down. You should recreate this. This is a good thing to recreate so you remember this better. But net income is 39098, 23200, and 39370. So net income margin is net income over revenue. So their margins went from 33% down to 20%, but they had a good 2023 up to 29%. So they improved their margins quite a bit. Same net income in 2021 and 2023. But they're so you think, okay, so they have this same, actually lower net income in 2023, but they're doing it with less shares outstanding. That's what you have to look at. So the earnings per share went up $1, which is significant. That's a big jump, $1. So the same earnings, because like if you had a business, you know, you had like say you had a business and it was $600 of profit. And you got $200 each. And let's just say this was in 2022. So you got $200 each. And in 2023, you bought out one of the partners. So you're actually, you have less profit. Your profit went down, went from 600 to 500, but you made more money because you have to share it with less people. So that's what people look at usually, is what they get at the end of the day. So profit is just one thing to look at. You want to look at earnings per share. So each shareholder actually got more money because they bought back so many shares. And when a company buys back shares, that's less money that the company can use to grow the business or possibly pay a dividend. So it improves your stake in the company. So a lot of people just look at the high level, but you have to also look at that type of stuff too. And then to take it, I guess, a step further. So if you look at the statement of cash flows, so if you looked at operating cash flow, which is even a better measure of how the company's doing, because that shows actual cash. Okay. So they actually convert. Their operating cash flow margin was 53%. In 2021, they converted 49% of their revenue into operating cash flow. It dropped in 2022. 2023 was higher than 2021. So even though net income was flat, they actually generated a lot more cash flow. And it's probably good to try to figure out why. Well, stock-based compensation, they spent a lot. That's going up to 14 billion. So that stock-based compensation is an expense. It brings down your net income. Somebody asked about that before. So it makes your income statement look bad. So of the 14 billion of stock-based compensation, this is how they break it up. Because stock-based compensation is given to employees. So it depends what department the employee works in. If they work in on the front lines, making the actual products, then their stock-based compensation is part of cost of revenue. Most of it is R&D, because that's where the higher paid employees are. So 11 billion of stock-based compensation are employees that work in developing products, which I guess makes sense. And I show you the unvested stock-based compensation. So this will lead to higher stock-based compensation in the future. So 149 billion is unvested. Some gets forfeited if some employees leave the company before they receive their stock-based compensation. Look how low the exercise price is in the 200s. Now it's 500. So I think stock-based compensation will probably go up a lot because a lot of employees will receive their shares since they're going to exercise, of course. It's kind of like options. Stock-based compensation. Yeah, I guess that's part of every company. They just have to give a lot to their employees. Accounts receivables, they had a big negative. So this means they sold a lot on credit, but they didn't. They'll receive the money, the payment, maybe in 2024. Accounts receivable recorded and carried the original invoiced amount less an allowance for any potential uncollectible amounts. We make estimates of expected credit and collectability trends for allowance for credit losses. So whenever they sell on credit using accounts receivables, they don't book the entire amount onto the balance sheet because they assume some of the amount won't get paid. Okay. Anybody have any other stocks to look at before I lose everybody in the stream? Big lots? Should we look at big lots maybe? Anybody have recommendations for a stock to look at? We can do a quick DCF and look at maybe look at their financial statements a little bit and see if they Dollar General. Let's see Dollar General. Dollar General. Are they still a $1 store, or did they switch to the $1.25 store? Because I know a lot of dollar stores switched to like $1.25 because inflation. $157.35. Where do you live? Every dollar has a dollar within a mile of them. Yeah, it's a good business because a lot of people like to shop there. Even people who make a lot of money like to shop at the dollar store. It's nice getting a deal. $700 million. Okay. 700, 1.3, 1.3, 1.6. Yeah, I'm at 127. They're trading at 157, so a 24%. A 24% premium. Yeah, Dollar General. Let's see if they. Simply Wall Street's at 196. 28. Okay, analysts say 142, which is closer to where I'm at. Business model struggling in modern America. Let's see. Okay, their business model is no longer sustainable as it charges a premium compared to larger stores and faces competition from Amazon and Chinese retailer Temu. The company's focus on lower income areas and smaller stores leads to higher theft and labor issues, impacting profitability. Dollar General's prospects are uncertain, with the possibility of pivoting towards a traditional grocery brand or facing increased competitive pressure. Okay, that's not good. They usually buy, sometimes they have regular brand stuff, like stuff that cost you $5 in another store or $10. They just buy in bulk, or stores that are trying to get rid of items that they overbought, like closeout stuff. It's not all junk. It's some of it's junk, not all of it's junk. Dollar General. Yeah, it's they have a lot of 20,000 locations. Yeah, it's hard to keep charging $1. It's almost like with inflation, at some point, things are going to cost more than $1, right? I guess they can sell less of something. Maybe because if a package of an item costs $1, in 10 years you would think it would cost more than $1. Maybe they'll just buy smaller items. Yeah, they've been around a long time. They've definitely struggled. I don't know. Yeah, they sell regular products, like regular brand names, because they try to buy it real cheap, 10 cents on $1, 5 cents on $1. So stores that purchase too much of something, they'll take a million products off someone's hands. They don't have $1 prices. Okay, so did they raise it to like $1.25? I thought I read that somewhere. How much are Dollar General prices? No, Dollar General has regular prices. Okay, so they're just a regular store. Yeah. There's a lot of these dollar stores. It's a good business model. It's got to be tough, though, to turn a buck. Yeah. Let's see. Dollar General to report Q4 results on March 14th. Okay, so they're reporting in next week. A great company still available at a discount. If you want good news about a company, you can find a lot of analysts say positive things about a company. If you want bad news about that same company, you can find a lot of analysts that will say bad things. Let's see their dividend. So their yield is higher than usual, 1.7%. So they pay a pretty good yield. That would be great if the CEO's salary was $1, because of the name of the store, the dollar store. That would be like, because there are CEOs that make $1 a year. I think Zuckerberg makes $1 a year. Others do. This would be the ideal situation where a CEO would make $1 at the dollar store. Of course, they get a lot of compensation through stock, but they have stores in rural areas. That is their competitive edge. Right. Yeah. They focus on lower income, smaller areas. Dollar General. Yeah. They were doing really well for a while, right? Their stock was. They have a pretty high RSI, so it does seem like it's overvalued. Well, it did come down quite a bit. So it was 260 at the end of 2022. It fell to 100. That would have been a good time to get it. I don't know if it's going to come back. Look at this gap down. That must have been during earnings. Another gap down. So you could only have so many gap downs before it comes up. So it filled in this gap. It hasn't filled in this gap yet, but it probably will. I think it's gonna. Yeah, they had to bring back the old CEO because their new CEO couldn't adapt to inflation. 35 billion market cap, so still not too big. So yeah, so COVID really helped this company stock, but they're right where they were pre-COVID. I mean, right before COVID, they were in the 160s, which where they are now. So, I think their revenue is probably a lot higher now than COVID. I don't know what it is in 2020, but in 2021 it's 33 billion. And they're profitable. And they have positive cash flow. Although their free cash flow is pretty low currently. It looks like they're spending a lot on CapEx. They must be opening up a lot of new stores because their CapEx is 50% higher in 2023 compared to 2022. $80. Yeah, that's a good time to buy. In 2017, I mean, 80. I mean, it's got to be painful. Not extremely painful because it's still up, but when you see it at 250 plus, and then it got down to almost where you bought it at. It got down to like what, 100 or in the high 90s. But that's why with stocks, you just keep holding. Eventually it comes back. Like when Meta came to 89, you just keep holding. You wait it out. And you get a dividend. You got your dividend. Yeah, that's the only way to make money in the stock market. If you try to make money on day trading, eventually you'll lose all your money. It's a long-term game. Okay. Well, hope the stream was helpful. I guess I'm gonna head off now. Thanks for commenting and anybody who joined. I probably will stream tomorrow after I do my video. Okay, I'll talk to you later. Have a good night.